Right. Hello, everyone. Thank you for attending to today's webinar. So as we mentioned just before I started the webinar as proper here, the topic is fundamentals and trading the news. Again, quite relevant, as today we've had a couple of news releases that have made some big moves, particularly in the currency market for the pound against the dollar. We had UK unemployment data, which was pretty well received. And then we had US Treasury Secretary Mnuchin talking down the dollar, saying a weak dollar is good for the US trade deficit. So, two news items that certainly would have helped you in the markets. Admittedly, you could probably trade the pure price action itself, not be completely unaware of those events, and still be able to profit from this gain in the pound. But we're going to talk today a little bit how those two things can work in combination, both the fundamentals and the how to actually practically apply that alongside the price action. So this is not an extensive guide on every single piece of news. This is more a kind of practical guide on what's the kind of key useful information on how you might be able to go about trading the news. Now this is our standard risk warning. Please have a quick read through that while you can. Now I'm going to disappear myself from the screen here, stop hogging up the screen space. But what I'm then going to do is, have you focus on the slides. And if there are any questions at any point, obviously feel free to shoot them through to me. All right, guys, thank you very much. Right, moving swiftly on from the risk warning. This is, as I said, we're not aiming to drag this out too much. So kind of 4 key areas looking to cover today. So 3 reasons you might want to trade the news, strategies to trade the news, the top 5 economic data releases. So as you can see here, I'm not covering every single piece of economic theory here. I mean, I'm just covering the 5 key economic data releases you'd want to look at when you're trading particularly the forex market. And then just last but not least, how the price action ties in with the news. So if you can ask yourself some questions here, definitely worth posing. Do you follow the news? If yes, do you use the information well? And do you use price action and do you understand its relation to the news? If not, why not? So these are questions we're looking to sort of address here. Of course, you can follow the news, but if you're not making use of it, then what's the point? You may as well save your time. Do you understand how the price actually relates to the news? I'm hoping to clear that up in today's webinar. So question 1, fairly obvious answer to this really. Would you like to win these kinds of pips? This was the November 3rd non-farm payrolls release. Caused a nice hefty little 40-odd pip drop here in dollar yen. Now, actually, by historical standards, that's not a massive move. You'd often in the past get 150, 200 pip moves on non-farm payrolls. It's lost its significance a little bit recently, but nonetheless, grabbing a quick 40 pips in the space of a couple of minutes, certainly nothing anyone's going to turn down. So how would you trade this? So obviously what we're talking about here is a news release. For those who don't know, non-farm payrolls is the monthly US unemployment report. It's important for the dollar because it obviously gives an indication of the health of the US economy, and probably more importantly than that, it gives you a little hint as to the next move from the US Central Bank, the Federal Reserve, on interest rates. And obviously any kind of good data, for example a drop in unemployment, makes it more likely that the Fed would want to raise rates, and that's good for the dollar, and vice versa. So here's 3 reasons to pay attention to the news. Number 1, trading news. there are economic events that happen every single day that cause price movement. And I just mentioned at the start of the webinar here today, there was a couple of events, but one that you had right there on the economic calendar, which you could have been trading off, was that UK labour market data. So UK unemployment this time and UK average earnings, both of which impact the British pound. And so as it so happened, that data was well received today, and it sent the pound quite significantly higher. So from that standpoint, follow the news, because you can actually get a good clue as to the timings throughout the day when there's going to be price movement that you want to capture, obviously, as a trader. So that's pretty straightforward. Number two is that you can compare how the news is affecting the price trends. So you can see, is a piece of good news driving positive reaction in the market, or is the market kind of ignoring the good news, or is it ignoring the bad news, and or is it reacting to the bad news? It gives you a sense as to the sentiment in the market. And generally, if the fundamentals and the technicals are pointing in the same direction, it increases your probability that the market's going to move in that direction. So, you know, if the US dollar, for example, as it is at the moment, is trending lower, and it seems like Donald Trump favors low interest rates, well, that's a piece of fundamental information, and the price trend both there indicating more weakness in the dollar. So of course you can trade the price trend by itself, of course you could trade the news by itself, but if they're both together, then obviously it just adds that little bit extra possibility that the trade direction you're taking and the timing of your trade is going to be correct. It's one extra thing to mention when I'm talking about timing, is actually obviously sometimes when you're trading the trend, actually timing your entries can be tricky. If you time it around if your entries are inspired by when there's likely volatility because of news releases, that helps you a little bit on the timing front. And last but not least, I mean, it's almost a jokey kind of point, but in a way it's very true. If you actually have some money on the line in your trade, it gives you extra reason to take interest in global events that affect you in ways that most people don't pay attention to. So obviously, extreme example, there's a global recession taking place. That's obviously affecting everyone. To understand why that's taking place is going to benefit you and your career and your family. So that goes beyond the realm of trading. But obviously if you're trading it, you're paying attention, you're understanding the news, gives you one leg up to understanding it for other areas of your life. This is where you can find the economic calendar on the LCG website. So it's just under the analysis and education section, and there's a specific section there for the economic calendar, and it's a pretty useful page. You can set up for this week, next week, add filters on countries, add in filters on different types of data, and it's obviously all comes out as the data is released. Gives you the consensus expectation from analysts about what the data is going to be and what the previous result was be. Generally how it works with this economic data is that if the data is better than the consensus expectation, then it's good for the respective market. If it's weaker than the consensus, it's bad for the respective market. That could even be the case even if it's a good overall number. If it's worse than expected, the market can still head lower, because theoretically the market has already priced in what was being expected. So looking more specifically at these news releases that come out, it's really the way to think about this is it's all about interest rates. What do these news releases mean for the direction of interest rates? Now these news has all sorts of different meanings, but I would encourage you to ignore those other meanings. They'd have really, particularly when it comes to currencies, it's where are future interest rates heading. If there's news that indicates that one currency's interest rates are going to rise respective to another, then the direction of the currency should be to the positive and vice versa. So top of the list here, central bank interest rate decision. So it just so happens today, as we're recording this webinar on Wednesday, the 24th of January, 2018, tomorrow is the ECB policy announcement. And so actually the euro's trading around 3-year highs against the dollar at the moment. So the trend is up. So we obviously want to see how the fundamentals line up against that positive price trend. With the central bank interest rate decision, it's pretty clear cut how that affects interest rates because they're literally making a decision on interest rates. So that's a pretty huge one. Oftentimes they don't make any actual change in interest rates. So why these meetings become important then is what the bankers say, what the central bankers say. Are they implying that rates are going one way or the other, or just implying they're going to stay the same? So second on the list, fairly closely related to that, is central banker speeches. They're giving talks all the time. These guys, they're almost professional talkers, and what they hint at, which is always fairly coaxed, fairly nuanced stuff. But again, it gives you a good flavour as to generally what the feeling is. And if you pay enough attention to what they're saying in their speeches, you can pretty much kind of preempt what decision they take when it comes to the actual meeting. Now, we talked a couple of times about unemployment. So NFP being the US unemployment report, the US is the biggest economy in the world, hence the non-farm payrolls US unemployment report is the most relevant, particularly when you're trading the Forex market and you're trading those major currency pairs, because obviously they all involve the US dollar. I think I've sort of already said this, but I don't want to repeat myself too much, but basically if the unemployment rate is dropping, the economy is looking stronger, there's more people in the workforce, likely is that wages start to get bid up, inflation should head higher as a result, and that just means it's more likely the central bank is going to raise interest rates to try and head off that overheating economy. Obviously conversely, if the unemployment rate's going up, obviously it doesn't look like the economy is performing as well. The central bank may look to, or may at least suggest, that they're going to cut interest rates to try and stimulate what looks like a cooling economy. And obviously that's what we've been living through since the financial crisis of 2008, is a very low interest rate economy because central bankers have kept interest rates low to try and stop us falling back into another recession. Inflation, sort of hinted at it a bit again there. So the big one really is the consumer price inflation, particularly in the Western world, less so in places like China because there's a bit more of an industrial base there. I mean, that's obviously what Donald Trump's all about, is bringing the industrial base back from the likes of China to the likes of the US. So basically the idea is why we follow the consumer price index is because consumption is the biggest part of the Western economies, and so that's the biggest driver on inflation. CPI is basically a basket of goods. I don't know what it includes. Sometimes there's some funny news about new items they've included in there, but it's basically supposed to be a basket of goods that represents sort of general purchases that people make. And if the prices of those things are going up, again, inflation's going up. Oftentimes higher inflation. Central banks typically have a target of 2% inflation. So if this CPI is running much above 2% for a long period of time, really to fulfill their mandate of a target of 2% inflation, these central banks need to cut interest rates. So you need to raise interest rates, and vice versa to that. If consistently you're seeing inflation of around 1% and their target's 2%, really they should be cutting interest rates to try and boost inflation up to 2% again. Last but not least, it's the most obvious one really, economic growth. Again, if the economy is performing well, it just means it's more likely for the central bank to raise rates in reaction to that. So back to this November non-farm payrolls release. This is that 40 pip drop in dollar yen again. I haven't labeled it dollar yen, but you can see probably from the prices on the side, the dollar yen obviously looks a bit unusual. Doesn't look like the other currency pairs. Got that in that sort of 100 pip 3 significant place kind of range. So written quite simply on the chart here, E1, E1, E1 question mark. What does that mean? So basically, the mistake a lot of new traders make when it comes to trading the news is that you think that you're faster than the market. That is to say that you wait for the news to come out, see whether it's good or bad. You look at it come across your screen, look on the LCG economic calendar, for example, see the good result, and bang on the trade. Unfortunately, it probably always was the case because banks have much faster sources of information, but it's particularly the case now with the likes of algorithmic trading going on, is that you're never going to be able to react quick enough to that. There are literally, the way the Forex market works specifically is an over-the-counter market. There are market makers at banks, but at other institutions too, who basically are setting the price for the market based on the supply and demand they see from the trades they get from their clients. And so if there's a piece of data that suddenly changes what they think is the fair value of the currency, they are going to change the prices they're offering. So this area here, this drop, while you may see a candlestick here, there really isn't a whole of a lot of trading going on here. And there may be some limited trading, probably between institutions. For the likes of retail traders, there's not going to be too much going on there in a fast-moving market. Before the data release, the price is at E1. When the data actually comes out, it's probably more like E1 question mark. So the point being that you can't wait for the market to just come out. Like sometimes you can if there's a bit of a stuttery first reaction because maybe the data is slightly mixed and the market makes its decision and then takes off. You can kind of get away with it. But to be able to just suddenly capture the market tanking, if only it were that easy, right? Unfortunately, it's not. And you tend to get these kind of gaps in the market, and that's just a natural function of the way the market's working as a result of the way these market makers function, as I just explained. So what can you do if you can't do that? Well, as I mentioned, have a look at the price action leading into the release. Typically, especially with the big releases like the non-farm payrolls, the price action will be fairly sideways. You'll often see a sort of box, rectangle, consolidation range, however you want to call it, forming in the lead up as the markets, as the big players sort of step out, don't drive the direction of the market anymore because they're waiting on this data release. So it gives you a pretty good flavor as to what's going to happen here, and oftentimes you can get a little breakout of the box before the market, before the data even comes out. That's, if you're a conspiracy theorist, that could be people already knowing the data. More likely it's it's the smart players have already got a pretty good sense of the data from their own research and are starting to put on trades. So you can actually get a little price action signal sometimes even before the market comes out based on the prior trading range. You can now obviously sometimes nothing's perfect. Sometimes those big players can get it wrong and suddenly it whips the other way, or maybe there's traders trying to send the market one way to capture buy orders at a lower price. There's different factors here. You can see in this particular example, you could have caught the breakout actually just using the price action alone, with the anticipation there was going to be more volatility to follow through from the fundamental release. So there are some options here on how you actually take advantage of this rectangle. So one option is that you can obviously use, there's different order types that you can use in trading, obviously. This particular example is using a stop order. So if you look at the price action prior to this, it's a bit sideways really in dollar yen. You can't get any real senses to the trend, so you don't really know necessarily which way the market's going to swing after this data. So what you can do is kind of hedge your bets. You put a short order below the bottom of the rectangle, a long order at the top of the rectangle, and basically the idea is that one of them triggers when the volatility kicks in. In this particular instance, obviously, it worked quite well to the short side. The long side would not even have happened. Sometimes you'll get a bit of a nasty situation where it'll whip one way, activate your short, and then whip the other way and activate your long. Well, it could be worse, because ideally that little short trade that you get knocked out of, you have a small stop loss, but that long trade you hold on to and make a bigger win from it. The other option here, which is kind of a savvier option in a way, but it's a little bit harder for people to kind of bring themselves to do, if you like, is to again recognize where this box is and place trades at the top and the bottom of the range, with the idea that probably one of them is going to stop out, but for a very small amount, but the other one, if the volatility does result, will give you a bigger profit. So in this instance, we've seen two peaks in the rectangle here. You put a kind of conservatively placed short up here. When the price swings up for this third time, you place a short in here, a few hours or minutes, whatever it may be, before the, this is a 5-minute chart, by the way, so if we're placing a trade there, it's sort of probably a half an hour to, in that sort of vicinity, half an hour to an hour before the data comes out. And then again, you have maybe a sense as to this being the bottom of the range. You have a little dip down here. You place your trade to the long side. So either you know the direction of the trend and you only want to be long or short. It's an uptrend, so you only want to be long. It's a downtrend, you only want to be short. Or it's a bit of a kind of rangy market like this one looked like in dollar yen. You place both with the idea that one of them gets stopped, but the volatility hopefully will be enough to mean that you win more than you lose. Now, the downside of doing both obviously is that that idea about the market gapping in one direction works for being profitable in the market, works for stop losses just the same way. So a limit order will activate at the next available market price, and as will a as will the sort of my mind's gone blank for a second here. What am I trying to say? The stop order, rather. Yep, I've kept having sell order in my mind. The stop order will activate at the next available price. So if you have a stop loss, which is a form of stop order, obviously, it's going to activate at that, not necessarily the price you set, but whenever the market reconvenes after the data. That's the downside of, and it makes it a little bit harder to control your risk on this strategy. As with all these things I'm suggesting, obviously practice it in your demo account, practice it in small size to a live account, tweak it to your own style to get a feeling as to the risks involved. Now, another option, something I might add probably wouldn't have worked out quite so well today, although to be fair, it would have worked out temporarily. I'll bring up that sterling chart in a minute. Is that you go back through maybe the last 3 at the minimum, but ideally sort of 5, maybe even 10 if you're particularly diligent. Are those sort of 10 months back? It's not quite as relevant. You look at the average size of the price reaction in the currency pair you're dealing with to this particular economic release. Not just any release, not just any pair, but the specifics of this release. How does this pair typically react? How much does it move? And then you just fade it. Because oftentimes these are kind of knee-jerk reactions from speculators like us, and doesn't actually have any particularly long-term impact on the market necessarily. Obviously the market's made up of all sorts of long-term factors that go into the direction of the trend. So you can get instances like this where the market just comes right back to where it started again in quite a short period of time. So if you'd actually just waited for the negative data to come out, for example, in this case, well, if it was dollar yen, it would have been maybe negative unemployment result, and then just bought it, went long, after a dip of 40 pips, which has been maybe the average move over the last few months of these non-farm payrolls releases, and then you just ride it back up to the 40 pips where the market began. So that's called fading the news. And again, it requires a bit of practice to get a feeling for it, and a bit of due diligence, and a bit of working out the statistics to put it best in your favor. Now, this looks a bit crazy when you first look at it, but this is how I'm trying to illustrate price action and the news. So what the idea is here is that we're showing a bear market, a bottoming process, and the transition into a bull market. Now, the whole time news is coming out, right? Particularly these days, it's a 24-hour market, and there's 24-hour news cycle. And so what you'll notice is that when we're in a bear market, or maybe more specifically just a downtrend in a particular currency pair, or even stock index, if that's how you trade things, then the bad news will have a bigger impact than the good news. So here the good news caused a little pop, but it didn't get anywhere close to the previous peaks. The bad news sends the market down through that previous trough and makes a new lower low. Again, good news may happen again, very minimal reaction in the market to that good news. The bad news sends the market down again. Now, I'm not saying it's news that's caused every one of these bumps, but you get the point. Then you reach the point where the good news again causes a big reaction, bigger reaction than you've been seeing recently, but again, not quite enough to kind of overtake previous peaks, not quite enough to suddenly send it in completely opposite direction. And then the bad news comes out. It does make a new lower low, but it makes a bit hard work of it. It doesn't seem quite as effective on the market as it once was. This is the transition phase where good news is starting to have a bit more effect, bad news is starting to have a little less effect. Why is that? Because actually the smart money is starting to think that actually after this big downturn, this particular currency pair or whatever asset it is starting to look a bit more like a bargain than it had been recently. It might be worth buying into in anticipation of a jump up to higher prices. And then you get to this point where actually, because of this kind of little kind of jolty bit down to lower lows, the good news actually does cause a higher high here, but above here. The bad news cannot cause a lower low. And this is a big indication point here. And then finally, this is the breakout trade, right, where the good news causes a breakout above the old high, and you see a massive move higher, and then the trend is really established, and then everyone's on board. And then the next bit of good news again sends the market flying higher. Bad news, minimum effects, and we're in a bull market. So simple idea, right? But that genuinely is how things play out. And so how do you use this information? Well, one thing is just to recognize the trend of the market and see how the news is affecting it. General idea being that in a downtrend, you don't really want to be trading the good news. It's not going to affect the market as positively. And in a bull market and in an uptrend, you don't really want to be trading in alongside that bad news, except on very short-term trades. Typically, as a rule for me, I just won't be doing it. So that's it. I hope that I kept it fairly short and sweet for everyone today. I hope that was useful. Going to be putting this on a web on the web afterwards. It's going to be on YouTube. It's going to be on Facebook. So feel free to watch it again then, and put any comments on there if you have any questions. Right. Thank you very much for attending, everyone. Good luck with trading for the rest of the day. It's Jasper Lawler signing out.